and welcome to our latest Insider interview. I'm Kyle Caldwell, and today in the studio I have with me Stephen Yu, Fund Manager of the Blue Whale Growth Fund. Stephen, good to see you today. So Stephen, to start off with, so the fund invests in the highest quality growth businesses that you can find on an attractive valuation. So could you talk us through your latest stance on one of your biggest holdings, which is Nvidia? You've held the stock for a number of years before it became a household name. So what is the current position?
So we still like Nvidia. I mean, they have done very well for us since we started our journey. Of course, if you follow what has happened in 2022, Nvidia's share price has gone down a lot, and the market cap trough at around $300 billion in October 2022. And we took that opportunity to increase our position to buy more of Nvidia shares at a very attractive valuation. But what has been very interesting was what happened over the last 12 months or so when Nvidia's market cap surpassed $1 trillion. And of course, that surprised a lot of people how quickly that happened. And then, of course, if you look at the market cap today, it's over $3.5 trillion, which is the biggest company in the world as we speak. And I think the way to think about Nvidia is how significant do you think generative AI is going to change the world, our day-to-day, in terms of either maybe you're in a professional white-collar job, or maybe you're just like a consumer. I mean, to our mind, like, we think it's going to be as significant as smartphone era that we have now spent a lot more time with our devices compared to before. So if you do take that view, then Nvidia would remain at the center of that ecosystem, being the GPU compute. Of course, we would expect competitors coming in, but Nvidia would still remain the core of that. So on that basis, we still like Nvidia.
And have you been taking some profits in Nvidia? I know on occasion the stock has been 9.9% of the portfolio, which is the highest it can go. So have you then been taking profits due to the fact that it's had such a strong run of performance?
Yeah, this is actually a very good point, because obviously we have been asked about this many times. If we didn't have a cap, which is a usage cap at 10%, that the performance of the fund would have been a lot better, just because the over time the position size would become bigger as Nvidia share price goes up. But of course, I mean, we are usage constrained fund, so we have been forced to take profits, I would say. So if you think about that, we have maintained just short of a 10% position between Nvidia's market cap at $1 trillion last year versus $3.5 trillion today. Then we have sold more shares in Nvidia than we currently own. So we actually have capitalized over £100 million of profit just by selling shares. So that is something that's very unusual, that has never happened before, just because Nvidia is such a big company, such an important company. But I think going forward, of course, I mean, we are very valuation conscious, and while you can still believe in Nvidia, which is like anything else that we used to think they can do very well, but of course there's always a time that maybe you want to assess other opportunity that might do even better than Nvidia.
Now, while Nvidia remains a top 10 holding, a stock that is no longer in the top 10, but has been for a number of years, is Microsoft. Why is that now a smaller position for the fund?
Yeah, Microsoft has been a very interesting company for us, because we started investing in Microsoft 7 years ago in 2017. Microsoft market cap at the time was only about $500 billion 7 years ago. Of course, now it's over $3 trillion. And that was a time that digital transformation, in terms of how Microsoft transitioned itself to become a cloud subscription business, that makes Microsoft very high quality at the time. And we were very early in that journey, hence we have done very well. And if you follow the fund top 10, that Microsoft has been a consistent top 10 holding for the last 7 years until August this year. So this is very unusual. We never have another company that would be comparable to Microsoft being so consistent in our top 10. So Microsoft is the only one that managed to have that position. But we started to get concerned about 6 months ago in terms of how much money has gone into AI. There's a lot of spending, right? So if you think about Nvidia revenue line 2 years ago in 2022, they were making less than $30 billion. This year, they're going to make more than $150 billion top line, right? So someone have decided to spend $120 billion with Nvidia this year compared to 2 years ago. And who are these people? Like these people would be, majority of them would be the big tech company, including Microsoft, Alphabet, and some others. And of course, then the question is like we do share some of the negative view about AI is how much of a return on investment can you justify that? And I think the quality of Microsoft going forward from here is going to come down versus what they have achieved before. And also, if you look at the capital intensity of the big tech companies today versus like 5-10 years ago, it's a lot higher, which means that they're no longer capital light businesses. And of course, then there's going to be a valuation number that would reflect that called deterioration in quality, isn't it? Because like if you're more capital light, it makes your company more high quality versus if you're capital intensive, as we all know, that you should maybe discount that a bit. So I think where Microsoft today is trading at all-time high valuation based on our numbers, and we just do not think that's going to is justified. But of course, I mean, we're not suggesting that Microsoft is going to disappear. I mean, we'll remain a very prominent company in the software ecosystem. But then, of course, from our perspective, we want to maximize the outperformance potential. And we are not convinced that Microsoft is going to do that from an investor's perspective.
Let's now move on to the rest of the fund. How many holdings do you currently have? And could you give a flavour of the types of sectors and themes you're seeking to profit from?
Yeah, so it's just over 25 stocks currently. And what we have got in the rest of the fund is we have got other themes in terms of exposure to luxury, to biologics, sports gaming in the US, and also into the consumer staples like Philip Morris, for example. And so the way that we think about this is, which is I think is important to expand on this point is, so on average, I think if I reflect on the last 7 years journey that we have on average about 40% exposure to technology companies. But of course that composition of the mix has been very different today versus 7 years ago. The company that we have invested within technology bucket are very different. We can come back to that. But I think what is really important on the back of this point is we're not fixated to start with. I mean, we don't have a mandate to say, okay, we need to have this exposure. But what's really important, I think, from an investor's perspective is like you need to think about what is going to make which company or sectors are going to make a difference in the real world. And of course, over the last 7 years or so, that technology was the place to be, and you need to take a reasonable exposure to that part of the market.
And could you talk us through recent portfolio activity? What have been the new purchases for the fund in 2024?
So we have done a few things in terms of resizing of positions and introducing new ideas or exiting certain position this year. And I think on a very high level that we remain to be very positive on AI infrastructure versus AI applications. So AI infrastructure would encompass Nvidia, Broadcom, or Vertiv. So Vertiv was a new company that they provide liquid cooling systems for data center. And if you follow the AI development, that AI compute is going to be a lot more energy intensive. So you do need to have some advanced cooling system in the data center. So Vertiv is a market leader to do that. So we continue to like AI infrastructure. On the other hand, that we have become more cautious as we talk about Microsoft or some other company on AI applications. So we have been reducing position on that bucket. We still like Meta because we think Meta would have the highest chance to deliver a high return on investment just because a lot of the investment are going to improve the efficiency of how they deliver advertisement to us rather than creating something new that you want to convince people like why should we be paying for the Microsoft Copilot or maybe Google Gemini in time, which is something very new to the ecosystem. And on the other hand, we also like sports gaming. We have increased our exposure to US sports gaming through Flutter and DraftKings. And of course, they have done very well in the US. They only started legalizing sports gaming a few years ago. So it's very new market to them versus like we're already very familiar with that in Europe or in Australia and some other places. And then we also like Philip Morris, which is something quite interesting that we have done very well on the back of Philip Morris. They have got the approval to market their IQOS product back to the US, which they have never been in the US since the spin off from Altria in 2008. And at the same time, they acquired Swedish Match a few years ago, which offer nicotine pouches, basically non-traditional cigarette products. So if you look at the composition of Philip Morris, they are now over 50% of the business would be in non-traditional cigarettes. So we would actually see this company as transitioning to become maybe more ESG. I mean, we're not running a ESG mandate, but they are doing a lot of things that are very positive within the market they operate in. And I think what might surprise some people is like everyone like to talk about Microsoft. It's easy to understand. It's a good company. But then Philip Morris in itself has gone up over 35% year to date, while Microsoft has only gone up about 10. So while you think, okay, Philip Morris sounds a bit boring because it's not an AI play, that's not really a theme. But actually, if you do the bottom-up research on this particular company, which is what we do, then you actually discover there's a lot of things that are helping the company to do very well from here. And at the same time, we would consider this as very idiosyncratic in a way that's not correlated to what's happening in the world. Of course, I mean, we can talk about the world being very uncertain, the dynamics, etc. So that's what we have done.
Now, the last time I interviewed you on camera was towards the end of 2022, which was a tough year of performance for the fund due to the fact that interest rates rose very quickly in that year. Performance has bounced back since then. Obviously, Nvidia's performed well, but could you talk us through other key performance drivers?
So if we go back in time in 2022, I think that a few things happened there. So one was interest rates gone up very quickly, and of course that has implication on valuation of many companies, whether you are high quality or not as high quality. And of course, I mean, for our company such as like Microsoft, the share price was actually down more than 25% at the time. But to us, it's not interest rate going up to 5% in the US is not going to fundamentally change how Microsoft business is going to do in the next couple of years. So I think there's a bit of a reset in valuation when we got into 2023 onward. So there's a bit of a natural recovery from there in terms of valuation reset. And at the same time, we have exited some major position in 2022 to shift into probably more AI related. Of course, I mean, that would have helped. And at the same time, I think what is really important in 2022 that we equally recognize that we had entered into a new regime, meaning that there's going to be increased geopolitical uncertainties, inflation is going to be very sticky, interest rate is going to remain higher for longer, which we are still seeing today. So what it means is there's going to be a lot of implications about things that would have worked, maybe let's say 10 years running with the pandemic versus the 10 years going forward from 2022. And of course, at the time, we initiated our first and only energy company called Canadian Natural Resources, which was very controversial because people don't really understand why we did that. But to us, the company is very high quality to start with. And at the same time, we do think under this new regime that Canadian Natural Resources would be able to deliver the shareholder return that we expect the company to do. So we took a position in that company into our top 10 for a period of time and did very well for us. And of course, then over time, I think what is really important in the last couple of years is there's a bit of like a gradual transition in terms of positioning as we see more news that's going to come in over time or the different macro backdrop. I think that is the role of an active manager, which is something that we feel very that's very important to us, because ultimately, I think, obviously, if you ask me to go back in time 7 years ago, could I have designed a portfolio of stocks, let's say 25 companies, that we would think they're going to do well in the next 7 years, which is the last 7? Of course, we would never have expected a pandemic to happen. We would never have even envisage that interest rate or maybe inflation could be like 10, 15% and interest rate going up so quickly. And then you have a few wars, election, etc. It's impossible. But as active manager, I think what we can do is to navigate the market on behalf of investors, seizing the best opportunity and then rescaling certain position that we don't think they can do well over time. So I think that is something of an ongoing development on how we manage the fund.
Stephen, thank you for your time today. So that's it for our latest Insider interview. Hope you've enjoyed it. You can let us know what you think. You can comment. If you like the video, hit that like button, and you can also hit the subscribe button for more future Fund Manager videos. And hopefully, I'll see you again next time.